Hey, what's up, everybody? Sam Parker here with My Credit Guy Credit Restoration. And yesterday I got a really great question in on Facebook from my good old buddy Dustin Mason. And he asked, is it better to take out a home equity loan or to borrow money against two vehicles that are already paid off? Okay, first of all, my personal preference is I like to not touch my home's equity because that's what hopefully when you're old and gray you're going to be able to fall back on. But it can also be a great resource for you if you need it. Let me just it's kind of a loaded question. So let me tell you this. First of all, there's really two different types of home equity loans that you can get. You can get a true home equity loan where it's going to be like a fixed rate, fixed term, and you're just borrowing money against that. Most people though go the other route and they get a home equity line of credit or a Heloc. Those are going to be revolving terms. So the one thing you have to keep in mind about any revolving account is that the credit scoring algorithm is not smart enough to know this is a Heloc and they took it out to do some improvements or to pay off debt. It just sees a revolving account the same as a credit card. So if all of a sudden you borrowed $20,000 against your home and you've spent 19, to the credit scoring algorithm's eyes, you have a maxed out $20,000 credit card. So keep that part in mind, okay? The positive about a Heloc is that you can write off the interest for tax purposes. So you could borrow against your house, pay off a bunch of bad credit card debt, get a way lower interest rate, and write off a lot of the interest for tax purposes. So a Heloc can be a very powerful tool, okay? Now let's compare that to borrowing against cars, okay? When you do that, most likely you're going to get an installment loan. Again, a fixed rate, a fixed and set term. And the installment loan is much easier on your credit, okay? Because the credit scoring algorithm understands that when you take out an installment loan, you're going to be maxed on it. You're going to borrow, whatever they've approved for you. Whereas with that revolving account, it doesn't care about that and it's going to really hit you hard for your scores. So it really just depends on what it is that you're trying to do and whether or not you care if your scores are going to take a little bit of a hit in the near future or if this is a strategic plan to pay off some debt. So I hope that gives you some more information, Mason, and everybody else out there. If you guys have follow-up questions, definitely post them down below and I'll make sure to get them answered for you. And if you have any other questions about credit, make sure to ask as well and I might use your idea for my next video. Thanks.